Good evening, everyone. Thank you for joining us for HCLTech's third quarter earnings announcement. First of all, Happy New Year to all of you from the entire HCLTech family. Let me start with the quarterly performance. I'm very happy to share that we've delivered a strong performance across all metrics: revenue growth, improving margins, booking growth, and the people metrics. Our revenues grew 5% in constant currency quarter on quarter and 13.1% year on year, again in constant currency. The strong revenue growth is attributed to both the momentum in our services business as well as our HCL software business. Our services business grew 15.4% year-on-year and 2.2% sequentially in constant currency. We posted an improved EBIT of 19.6%, driven by improvements in our services business and a huge uptick coming in from the seasonal gains that we have in the software business. Overall, we are continuing to see a good demand environment, especially deals which are IT operating model changes is a very important theme, and we are seeing significant traction there. Cloud adoption is another theme on which we are seeing some good traction. And the third element is vendor consolidation. We see there is a significant amount of opportunities and wins that we've had on the vendor consolidation. So vendor consolidation, cost optimization, and integrated opportunities will drive the growth in the near to midterm. We also enjoy a very unique position as the only service provider to be in the leaders quadrant in the 6 magic quadrants of Gartner. We are the only provider, and we are very, very proud of this recognition. And this recognition is also reflected in the good bookings that we've had. We had a very strong booking. I'll talk about it in a few minutes. Our software business delivered an outstanding performance. It grew 30.5% quarter on quarter in constant currency. They also scaled up impressively this quarter, and they won 26 new SaaS deals. SaaS conversion is one of the opportunities and strategies that we've been pursuing, and we had some very good success there. From services perspective, our engineering and R&D services business led the growth with a 2.5% sequential growth, constant currency. And IT and business services grew 2.1% sequentially, again in constant currency. This growth came up despite furloughs that were higher than anticipated at the start of the quarter and higher than what we saw in the previous year. In terms of our software business, we signed 7 new clients, Fortune 500 and Global 500 clients, and Global 2000 customers in the last quarter. We already have 25% of the G2000 companies as our clients for the software business, and we continue to see a synergy between our software and services business in a number of clients. HCL Software announced a multi-year partnership with the legendary Formula One team, Scuderia Ferrari. Ferrari's become a strategic partner for HCL Software and really focus on supplying high performance precision technology for the F1 team. So you will see HCL Software logo was very visibly present in the recent Formula One season. We continue to kind of leverage our partnership with the New York Jets and Giants, for whom we are the digital transformation partner. So it continues to be a good uptake for us. Now coming on to the verticals and geographies, Europe led the growth with a very strong 7.2% sequential growth, followed by Americas at 0.5% quarter on quarter in constant currency. And our top performing verticals were life sciences and healthcare, manufacturing, telecom and media, delivering sequential growths of 5.5, 4.9 and 4.5% in constant currency sequentially. From a booking perspective, our bookings were $2.35 billion. It grew 1.9% from an ACV perspective and 10% on a TCV perspective on a year-on-year basis. We won 17 large deals across services and products. In services, we had a very significant win, greater than $500 million deal for a US headquartered Fortune 300 financial services company. They selected HCLTech to modernize their IT landscape, leveraging cloud along with Amazon Web Services. HCLTech will enable a seamless migration to the integrated solution, leveraging the cloud platform, driven by automation and the migration process. We also announced a deal with ODP, which is Office Depot Corporation, a leading provider of products, services, and technology. They selected HCLTech as a primary IT partner for their digital transformation and all IT operations. We also announced a deal with a leading company in the US, a toy manufacturing company. This is a stellar deal, which is vendor consolidation, and it's really pivoting them from a traditional operating model to a product IT operating model, which we just announced. We also made good additions to our client pyramid. We had 3 additions to the $50 million clients and 2 to the $20 million category. Our pipeline continues to be healthy and well distributed across large and medium-sized opportunities. In terms of people, Ram will provide a little more color on the people, but we had a very healthy net addition of about 3,000 people. In terms of ESG, one of our medium-term objectives is to weave ESG into our business strategy. We launched HCLTech Sustainability School and the first comprehensive climate literacy learning program across 219,000 people last quarter. This helps our teams to understand the impact of climate and what they can do in their own lives and as a part of the organization to make the planet a better place to live. In terms of looking ahead, we believe there is a near-term impact to a few industries like technology industry as they optimize. This will continue. While there will be a little bit of optimization, we believe in the near to mid-term, it will really be a good growth opportunity for us, especially with the right propositions. In this context, our propositions, global delivery, talent, new capabilities will continue to give us an edge in the mid to long term. I must remind you that Q4 is a seasonally weak quarter for us as our P&P performance peaks in Q3, so you will see a dip in Q4. So looking ahead, we remain very positive of the medium-term growth, and really our confidence in the growth is really coming from good bookings and pipeline across every segment. So with that, I will hand over to Prateek to provide more details.
Thank you, CVK. So, as I look at the report card, I can only summarize it one way. It's a quarter of 19s, right? It's like 19.6% growth year on year in rupee terms, and it's 19% profit after tax growth as well. So it's like very well balanced. Whatever growth we've achieved at the top line has translated into equal growth at the bottom line. It's also a quarter of milestones because for the very first time ever, we've crossed 5,000 crores of EBIT in one quarter and 4,000 crores of profit after tax. So that's how I would summarize it. Going back to the typical numbers, the revenue for the quarter came in at 26,700 crores, round number, which is the 19.6% growth on the year. And that's on the back of a 22% year-on-year growth in the services business. That is what has driven that 19.6. And in constant currency, the growth was 13.1% because obviously rupee depreciated. It gave us that extra 6.5%. And that also was driven by 15.4% in constant currency in services. So clearly that has been the driving factor. As far as the quarter is concerned, on a sequential basis, it grew 5%. That was largely driven by, the big contribution of 30% plus came from the software business in constant currency. And services also reported a good 2.2% in a seasonally softer quarter, that is December. Profit was, EBITDA came in at close to 24%, 23.9 to be precise. EBIT at 19.6%. That was again a 165 basis points improvement versus the previous quarter. Previous quarter was 18%, 19.6 this quarter. Again, led by software flow-through margins. And the profit after tax came in at 15.3% of revenue, which is up 117 basis points. Return on invested capital, which is a key metric that most people track. We are at a company level, we are at 30% ROIC. And in the services business, that number is 37.4% actually. So I think a very satisfying quarter from all perspectives, growth or profitability or ROIC for that matter. And the guidance, we have narrowed down the guidance. We have given 3 points. So the overall growth guidance, we've kept it at 13.5 to 14%. The services growth is higher than that. It is 16 to 16.5%. And margin guidance, again, we have narrowed it to 18 to 18.5%. This quarter, like in previous quarters, also saw good cash generation. Cash in the last 12 months, operating cash flow is at $2.04 billion, which is close to 16,000 crores. And FCF is at $1.8 billion, which is 14,270 crores for the last 12 months, which is at 111%. OCF is at 111% of the profit after tax, and free cash flow is virtually equal to the PAT at 100%. The balance sheet remains strong with the gross cash at just under 20,500 crores and net cash at 16,150 odd crores, which is close to 2 billion. 1.95 billion to be precise is the net cash in the balance sheet. With the profits this quarter, the last 12 months diluted EPS stacks up to 53.36 rupees, which is a 4.8% sequential growth and 13.1% year-on-year growth, which is in line with the constant currency growth of the whole company. And the dividend declared is carrying on the 10 rupees per quarter per share. That has been declared by the board for this quarter as well. And the record date is 20th January. Payment of the same will be 1st February. With that, I'll pass it on to Ram for the HR update.
Thank you, Prateek. Good evening, everybody. One more good quarter. One more good quarter. Our people count has increased this quarter again to end at 222,270. That's an increase from the previous quarter of 2,945. So that's a good growth for this quarter. Another very good update is on the attrition. That's been an area of attention for a period of time. After 3 or 4 quarters of increase in attrition, we have seen a significant drop in attrition. Attrition for this quarter ended at 21.7%. That's a 210 BPS drop from what we reported in the previous quarter. The quarterly trend on attrition is quite positive. There's a significant drop in the quarterly attrition. So that indicates that the attrition trend line will look encouraging going forward in the quarters ahead as well. So that's a brief update that I wanted to give. We can move into Q&A.
The floor is open for questions. I'll move the mic around. Anybody?
Your mic is not. Good evening.
Yeah, so I think just a a couple of queries. The numbers are very strong, and yet there is, you have narrowed down your the guidance margin. So just want to understand what is it, that is driving this, this reduction. And I think specifically for Ram, I have a few queries. If you could help us understand, what are the things that help bring down employee costs. I saw that the share of employee costs has gone down, and within this also, because the number of freshers you've added, it is around 20,000 I believe for the year so far. Just want to understand if we are still on target for the 30,000 odd freshers that we were planning to onboard this year, and also if you could give us some visibility on the variable pay for the quarter.
You want to do the revenue projection?
So, I didn't catch your names, Romita, right. So, Romita, we had given a guidance, we had increased our guidance substantially last quarter. If you remember, from 12 to 14%, we took it all the way to 13.5 to 14.5, right? That was in October. And a lot of things changed in those 2 months of October, November, when all the tech majors and pretty much all the companies around the world came out with their results. So that was the reason on December 8th, when we did our US Investor Day, we did talk about being towards the end of the lower end of the guidance range. And that is what we have basically reiterated. So it's nothing that we have brought down compared to the December 8th or 9th, what we said. It's basically the same thing. Yes, if you compare versus the previous quarter, it is lower, because lower meaning it's the same range, it's just the bottom half of the range.
So are there any specific areas that you want to call out, areas of concern?
No, not area of concern, but Q4 is seasonally again a weak quarter for the software business. So software has peaked, and you will see a drop in software business in Q4. So that pretty much kind of brings down the growth in Q4. So that's really the numbers.
It's
And,
seasonality, nothing.
And maybe you want to add the employee cost, and then Ram can address the.
Yeah,
attrition.
okay, yeah. So employee cost is a factor of 2-3 things actually. One of them, the easiest one, is the forex rate, because as you know, most of our employees happen to be in India and paid in rupees. So when the forex changes, so that's one component of it. The second is, obviously, we have been, for a few quarters now, if you see for the last 3-4 quarters, 3 quarters at least, maybe 4 now, we have been focusing on hiring more and more freshers, and laterals, which is the net number if you do total minus freshers, is actually been going down last 3 quarters. So those are the factors that contribute to it. There's an opposite factor also, because this was a quarter of increments for our for a substantial portion of our workforce. So all these factors, but overall I think we are on a trajectory of improving efficiency. That's what we've guided in our Investor Day also, saying that we do want to get back as soon as possible to our pre-COVID, or our comfort band of 19 to 20%, which we are working towards. Thank you.
Since you mentioned improvements, if you could also tell us the range of improvements that have been given out.
It's an impact of about 70 basis points. So range would be what?
So we did
7-8%.
we did 78%
Yeah.
increment range.
There were a couple of other questions you had on HR.
So there was one on variable pay, and I think you had one on freshers as well. So let me take the freshers one first. You mentioned that we've done about 20. So we've done, in the first 3 quarters, we have done more than 22,000. We'll get pretty close to the 30,000 plan that we made for the year. We may fall slightly, marginally below that. And that's a moderation that we're doing because of the improvements in the retention rates that are there. The extent to which we have seen the attrition drop quarter on quarter for the last couple of quarters, I think that's significant, very encouraging. So to that extent, we'll do some small moderation, but we'll be pretty close to our projected numbers. So that's on freshers.
If I may just add, sorry to interrupt. We actually did 30,000 in the last 12 months till September. And this quarter also, if you take the last 12 months, we are at 29,500 or something. So we are already there. It's just a fine tuning that Ram is talking about.
Yeah, if you do the last 12 months, we are hitting that 30,000 number. If you do the 3 quarters and then the 4th quarter, there'll be some moderation that we have to do. Variable pay, you would have noticed that even in the previous 2 quarters, we didn't make any change to our variable pay policy. We continued with our policy. We honored whatever variable pay policy commitments that we've had. I don't see any reason why we would make any change to our variable pay plan. We will continue with our plans.
And that will be how much?
So, variable pay, as you would expect, it's going to be linked to performance. It's not just about business performance, it's also about individual performance. So there will be variances at an individual level. It generally is going to be that a significant proportion of the workforce will get close to their target variable pay.
And that at entry level, see, we don't have variable pay every quarter. Only for the entry level talent, there is a variable, small variable pay at the end of quarter, and that is pretty much gets paid at 100%.
Ram, just one last query would be, what is the general talent demand environment, especially for lateral talent?
So our growth is driven by all the newer areas where there is growth momentum, whether it is cloud migration, cloud adoption, or digitalization. So all those areas are the areas where the talent demand is. To connect it back to the previous question on employee costs, one of the other things that we are driving significantly is our investment and efforts in upskilling. So for example, this quarter, the training hours, skilling effort hours was 3 million hours, which is almost like a 50% increase on what we have done in the previous couple of quarters. So there's significant emphasis and effort going into upskilling the existing people. So that's another important factor. So the demand is all in the area where you see upside from a client plan perspective. So we are aligned to that.
But is net hiring coming down, because this quarter it is significantly down compared to the previous quarters?
So net hiring, as I said, net hiring is a function of a couple of things. One, net hiring is a function of attrition. And when you have a significant drop in attrition, we also moderate our gross hiring. So to that extent, you will see the net numbers move around a bit, right? And it's also a consequence of the previous quarter being the quarter of the campus season where we had higher freshers taken in. So those are a couple of reasons.
Gentlemen, I have a couple of questions, and since you were talking about headcount growth and the trends, my first question is of course related to headcount addition that has slowed to 3,000 versus 8,000 quarter on quarter. Is that really an indicator of slower growth? So you mentioned about a slower quarter. Seasonality aside, what are the other factors that are going to lead to that slower growth? And of course, solid shown margins with 160 basis points expansion, but your guidance is 18 to 18.5%. Would there be some margin headwinds in Q4 apart from seasonality, like I said?
So let me take the second one first and then.
Yeah.
Okay. So as far, see, there is a seasonality in the products business, software business. That is the one which, and we are publishing, services margins separately and software separately, right? So software is like 32.6 this quarter, was much lower in the last quarter. And if you look at services, it is 17.6 last quarter, 17.7 this quarter. So next quarter, would be led by the services, because seasonality in software is not going to be there, right? So next quarter will most likely be lower than 19.6. That's the seasonality, how it translates into the numbers. And therefore, the total year would be, we started at 17% not so long ago. Remember, the first quarter was the trough at 17. So we made it up. We are now on a good runway to 18 to 18 and a half. Ram?
So on the headcount thing, we need to look at headcount, net headcount addition on a rolling 12-month basis, not just one snapshot of one quarter, because many a times hiring happens on a proactive basis. So it all depends on how much of proactive hiring has happened, and then you keep moderating that on a monthly basis. So taking a one-quarter snapshot for headcount and trying to project on the basis of that for future quarters may not give the true picture. We need to look at it on a trailing 12-month basis. So I don't see this as an indication of any moderation to growth. We just heard the commentary that the order book remains healthy, so there is demand. This is not an indication of any slowdown.
Yeah.
Hi, good evening. I'm Saurabh from Business Standard. It was surprising to hear that Europe has led the growth this quarter, despite the energy cost and macroeconomic situation there. What was the factor driving this growth?
So Europe is really this quarter's revenue numbers are really dependent on the bookings in the last 2 quarters, right? So we had some good deal wins in the previous quarters. Now they are getting executed, and that's what is driving a very strong growth in Europe.
Going ahead,
Going ahead, there will be a little moderation in Europe because the decision cycles are getting delayed in Europe, even though we had a very strong booking this quarter, but Europe is a little soft. So you will see some moderation in Europe in the coming quarters.
Thank you.
Hi. Over here.
Yeah, please.
Hi. A few things with regards to the overall drop in attrition and employee costs. Do you expect this to reflect positively on the margins for overall this financial year and the next financial year as well? And also, what are the other factors that could impact the overall margin, given the kind of uncertainty in the markets and tech spends that we hear about?
So, I mean, your first question, obviously, yes. I mean, wages or salary costs is the biggest cost line item we have, 53.6 or something like that, right? So that is the biggest driver of the margins. To your other question, what are the levers? I think we've talked about it partly during the day today. It's more and more induction of freshers, getting them quickly trained and deployed on projects and billing them, right? So time to bill and ability to sort of induct and deploy freshers counts. As we do it year after year, quarter after quarter, that builds the bottom of the pyramid to be the right cost levels. And utilization of the overall pyramid is the other big lever. So those are the ones which we are focused on. Reducing our dependence on third parties and outsourced work is another lever which we have again deployed successfully. And then there are a long list of other measures like offshoring and nearshoring, which we are also deploying, and so on and so forth, automation, all of that.
Hello, Ayanti from Informist Media. Can you talk a bit about your long-term strategy for the software business, and how do you see the revenue mix changing going forward?
We don't expect the revenue mix to change. I mean, software business, it's under a transformative phase. So we expect in the near term software business to be flat. That's been our overall guidance on the software business. And so services is growing much faster, so services mix will go up as we go into the next few quarters. Yeah, long-term strategies, really we are focused on The whole software business, we are kind of narrowing down to 4 focus areas. One is digital transformation, where we have commerce, Unica, marketing automation, and a few products like that. And the second theme is intelligent automation. And the third is data and analytics. And fourth is enterprise security. So all the products are getting classified, and we are getting more focused on 4 themes. And we want to kind of strengthen the offerings in these 4 areas. And that's one dimension. The second dimension is we want to, as we kind of keep progressing, we want to convert more and more software into software as a service model for a few products. So this quarter we had more than 20 wins in the SaaS offerings. So these are the 2 dimensions. One is to focus on a few offerings and then kind of transform the products into SaaS model.
Just one more thing on the $100 million plus deals. I think that's remained flat for this quarter, but I think the pre-earnings commentary was that we'd be expecting such a metric where smaller deals but a larger number of deals would kind of play like a trend in the market. Is that something that HCL also sees?
No, I think when you look at the client category, it really represents the last 12 months revenue. It's not a booking metric. So the new deals and small deals, large deals, etc. is the booking metric, whereas the client category is the last 12 months revenue metric. So there isn't a one-to-one comparison here.
There's been increase in net margin by 170 BPS. So what is the trend that you see, and which are the geographies? If you can highlight it geography-wise, that will give us an idea of the macroeconomic perspective.
So, geographies we typically talk about more in terms of the revenue, because we are really not disclosing even EBIT on a geography basis, right? So, forget about net margin, which is even lower.
Our segments are service-based, actually.
Yeah.
Reportable segments.
Europe, you have grown, and you have grown fastest in Europe.
Right.
So margins are also in line, or there has been some kind of dilution?
They would be generally in line, but we are not disclosing them separately is the point. But if you want to talk about growth.
Europe has grown well based on the bookings that we had in the past quarters, as we explained. And margins, the services margins have kind of marginally improved over the last quarter. And I think across geographies, it will be a similar trend, nothing to call out about Europe as such.
Any guidance on going forward, like for another 1 year, or how the trend is likely to be? What are your...
Yeah. So we continue to see good growth opportunities in the medium to long term because, see, first of all, as I said, there are 3 themes, right? IT operating model change is a big theme. Cloud adoption is again a big theme, which is driving more wins. And the third thing is vendor consolidation. I think there's close to $115 billion worth of vendor consolidation deals that will get decided in the next 3 years. And we being a strong player with very strong recognitions across multiple analyst recognitions, so we will definitely benefit from the vendor consolidation opportunity. So these are some triggers, and obviously when we start the next year, we will give you a outlook of what the next year will be.
Segment-wise idea where you are going to gain on margins with this consolidation?
Sorry, any segments?
Industry segment.
Vertical segments? I think, I think it's more uniform across the industry segments, but we see more consolidation in financial services, and the retail CPG segments are a little bit more compared to the other segments.
There are no more questions on the floor, then I'll pass it on to my colleague Devneeta, and she'll pass it over to some media who joined us remotely. Devneeta, over to you.
Thank you, Ashutosh. Now we will move on to the people who have joined us virtually. In case you are on your computer system and want to ask a question, please click on the raise hand icon on the bottom right of the participant panel, and we will unmute your line. In case you have joined us from the WebEx mobile app, please tap on the person icon on the top right. and then tap on the raise hand icon on the bottom of the screen. And in case you have joined on audio only, please press star 3 to raise your hand. Let me start with the first question. We have got Surbhi from the Economic Times on the line. Surbhi, I'm unmuting your line.
Good evening. I just wanted to understand that while you have said that in Europe there is some softness expected, how does US seem to you? Because some of your, sort of CEOs of IT firms have said that there are some slowness in decision making. Obviously, we have seen a lot of layoffs in the recent past. What does it look like? What does the next 6 months look like to you from where we are right now, CVK?
Yeah. So from a US perspective, see there are two spend patterns, right? One is really run the business, and the other one is discretionary spend. And as we are seeing a lot of operating model changes, a significant part of discretionary spend is also embedded in the run the business or DevSecOps kind of operating model. So we think there will be some moderation in the discretionary spend, and I think that is going to be common across the globe because different geographies have different triggers why they will moderate some of the discretionary spend. That's one aspect. But the second aspect is this vendor consolidation, cost optimization, and customers have committed to a certain amount of cloud consumption, so they need to migrate to cloud to really benefit from the spend that they're already invested in the cloud platforms. I think these 3-4 themes will continue to play out, and this is a fertile ground for good large deals to come in the next 6 months to 12 months. So I think it's going to be a mixed story. Discretionary could moderate, but more structured IT operating model changes, vendor consolidation, and cloud adoption, large opportunities are likely to come up.
Right. Just a follow-up question. Since we're just started 2023, what does client spends for the rest of the year look to you? Are you also hearing of some delays in decision making on that front when it comes to deciding on the budgets for the full year? How does the macro look to you from that vantage point?
From the client budget perspective, I think it's a little early. I think we will probably have some kind of insights into client spending and what areas they would really kind of divert the spend and things like that in the next couple of months. So I mean, macro is, I mean, what you know is, I mean, what we know is as good as what you know. So there's nothing more to add. I think we are totally focused on the overall, the tech spend is expected to increase this year. As per all the reports, still the tech spend is expected to increase because a lot of customers have embedded the digital transformation programs into their core budgets for the last many years. And it's likely to continue. While there could be some moderation, but the total tech spend is expected to increase as per all the reports. So we have to base all our judgments based on that at this point.
Right. Thank you.
Thank you, Surbhi. Our next question is from Dibangana Ghosh from Money Control. Dibangana, I'm unmuting your line. Dibangana?
Yeah. So hello, gentlemen. I have a couple of questions around the vertical-wise performances. So vertical-wise, I believe financial services and retail and CPG Q-on-Q growth in constant currency term has come out in negative. So what's the outlook on these segments for the upcoming quarters? And also would like to know a little bit about how the platform and product businesses have performed this quarter.
Okay, financial services, the reason it is declined is, as we indicated, December quarter, the furloughs were a little higher, and that's what has caused this. And there's been some ramp downs in the retail CPG segment, which has caused this decline. However, both these verticals, we've done some very large deals, both last quarter and this quarter. So I think the outlook for these two verticals in the future quarters we are very positive and bullish on what can happen. And what was the second question?
How has the platforms and products businesses performed this quarter?
What we have reported, we've had a fantastic growth, 30% sequential growth, and from a year-on-year perspective, we are flat. So I think that's the performance this quarter. It's a seasonally a strong quarter. That's why you see a big uptick in revenue this quarter in P&L.
Sure. And I have a question around the furloughs. I think during the investor day in December, you had mentioned that the furloughs have been higher than expected this quarter. So are these sector specific? You already pointed out financial services to be one of the segments where furloughs have been high. Are there other sectors that you are wary of? And secondly, has benching gone up in the recent quarters as compared to last year, given the macro challenges?
No, I think we did mention at that time financial services, tech segment, and a little bit in telecom. These are the three areas where we saw the impact of furloughs.
The next one was bench.
Yeah, there is, I mean, of course, we still have a lot of demand, so we're all growing, so there is no real concern of bench at this point.
Sure, thank you.
Thank you, Debangana. The next question is from Reema from CNBC. Reema, you may please go ahead. Reema?
Is there, can you hear me?
Yes.
Okay. My question is there a risk that furloughs extend into Q4 as well in any of the verticals? And do you see softness in any vertical in the current quarter, March quarter?
So, Reema, traditionally, some of the furloughs have kind of extended into the January month, especially in some APAC markets. So, we expect to see that trend this year as well. But it's all baked into our guidance of 13.5% to 14% full year, full business, and 16 to 16.5% on the services business.
But will the furloughs in Q4 in the APAC region be higher than what we typically see? And which verticals would they be concentrated in? And the next question is on deal wins. If discretionary spending is coming down, is there a risk that deal wins moderate from here on? Currently, you're tracking a run rate of $2.4 billion. Can that see a step down?
Yeah. So I think first is Asia Pac, the furlough impact is largely kind of focused on financial services. That's only vertical in APAC where we expect some furloughs. So the deal win, basically, if you look at on a last 12-month basis, we've clocked in $8 billion, maybe $9 billion in the last 12 months. Now, I do think a similar momentum will continue, even though there could be some spikiness from a quarter-on-quarter perspective. We feel confident of growing our full year booking because of the qualified pipeline, the deals which are likely to come into the pipeline. All of that is looking good. So I feel positive about the total booking. However, the mix of booking will change. I think it will reduce a little bit on the discretionary side, and it will increase a little more on the vendor consolidation, cost optimization, and cloud migration kind of opportunities. And more integrated end-to-end operating model changes is where we see large deals. And I think that will more than compensate some drops that we may see on the discretionary side.
Okay. And can you give us a breakup of your current deal wins in terms of net new? What were the renewals and what were the deals that you won against competition by, say, in vendor consolidation?
Yeah, Reema, we make it very easy for you. The only number we call out is the net new wins, right? That's okay. All the numbers that we call out every quarter is net new wins. So renewals are excluded in our booking. So $2.35 billion, what we called out is all new wins. And the three deals that I called out, first one, which is a large financial services firm greater than $500 million. It's again a significant cloud transformation program, which is a hybrid cloud transformation program in partnership with AWS. The second deal that we announced was ODP, which is again a very large vendor consolidation opportunity, which is making us the primary IT partner for Office Depot. And the third deal which we announced today is Mattel, which is really an operating model change, where we are replacing one of the large end-to-end service providers in that account is being replaced by HCLTech. So we are becoming the primary partner driving the entire IT operating model transformation for Mattel. So I think this will give you some flavor of the deals that we won this quarter.
Got it. Fair enough. So can you give us an indication then in terms of renewal or in vendor consolidation to understand that, when you say you've been winning market share, you're positioned favorably in vendor consolidation, could you, support that with some numbers?
I mean, see, first of all these, like the last quarter, we announced a large deal, which is again, we are gaining market share. We won against one of our larger peers. And this quarter, we won, the 3 deals is again in the similar service providers where we are gaining more traction. So I think our net new wins is the good indicator of growing market share.
Thank you, Rima. I think we just have time for one more question. So Sethuraman, we are just unmuting your line. If you could ask your question. Sethuraman from Reuters.
Just wanted to know, what is your view on the EBIT margin for next quarter, and how do you look to end it? It was a good one this quarter, and also how strong is your large deal wins going forward? So Mattel, I just want to know whether it's going to be like a Q4 one or you're putting it in Q3. Also, so finally,
announcing it today. It is a Q3
right.
win. So on the
Right. So I just want to know, despite several strong deal wins, deal pipeline commentary, and all that, you still feel that the narrowing bit of your full year revenue. So does it mean that it's going to be a huge moderation in Q4? And I also want to know your views on heading into next year, because the recession bit is expected to be much more severe going to the next financial year. Thank you.
So maybe I'll Sethuraman, Pratik here. So first of all, I can't give you a number for EBIT for the fourth quarter simply because there is a range of 18 to 18.5 that we've given, and I have not done the math myself, but it should be fairly easy to calculate after removing the first 3 quarters actuals, right? It'll be around that 18% mark-ish is what I would assume. It'll be a range of maybe 17 to 19 or something like that. Just doing some very quick back of the envelope math. To your question about large deal metal, typically the announcements that our clients do allow us to sort of call out, especially with their names and things like that, happen with a lag of at least 2-3 months, sometimes even more. So Metal was a deal that was booked during the quarter. It's certainly part of the 2.35 billion. And to your point about narrowing and moderation, like I explained in one of the previous questions, it's really not that. It looks like that if you compare versus what we said in October at the end of last quarter. Yes, it does look like that. But when you compare it with the midpoint where on 9th of December, we actually gave you a further guidance, which was towards the bottom end, lower end of the earlier range that we have given. We have just stuck to that. There's nothing new in the range that we've given this quarter actually. And there is no moderation, there's no recession, there is no narrowing. I don't know whether recession will happen or not. A lot of economists have talked about it. The newspapers talk about it. Maybe it will happen. They are all talking about second half of this calendar year. We are still 6 months away. I don't know. We'll see what happens.
I think we'll close the session for now. Thank you so much.
Thank you, everyone. Good evening.
Thank you.
Tea and coffee outside. Thank you.
It's time.
Or-
Yeah, it's time.